evening, Marshall Reddick clients and new people joining us this evening. This has been a very hot topic. So many of my clients have been reaching out to me asking, how is this going to impact us? There are positives and negatives to everything, and we're here tonight to discuss what the market trends have been and where they're going. These are the topics that we are going to be covering. Employment history from 2010 to now, loan limit history, the effect of coronavirus and what it's doing to the interest rates. Number 4, why the Fed dropped their fund rate, and the safest markets for investors or people looking to purchase. Since there are a lot of new people on the call tonight and returning members, I wanted to share a little bit about who we are and what we do. We've been in business for over 30 years. We are a research company, so all the markets that we help our clients invest in are for very strong reasons, which I'll dive into, I think, on the next couple of slides. We have everything that you would need from beginning to end in a transaction. So you would have real estate brokers, you would have property managers to take care of your properties afterwards if you're not buying them here in California, or maybe you buy it in California and you just don't want the liability to manage it yourself. We have CPAs, most importantly lenders, which we're here to listen to tonight. With Reed Hazard, I have done multiple 1031 exchanges, so many things and more that we are here to be a resource from beginning to end. This is me, licensed broker, had my license for over 8 years now. I've helped over 600 people buy and sell real estate, and we're in 16 different markets. And of course, locally, I'm able to help specifically hand in hand with you rather than referring you to a valued colleague and or coworker of mine. So had my license since 2012, been with the company. My anniversary was in February, for 7 years now. I average about 85 sales per year. So I really love what I do. I'm passionate about it. I'm second generation to the company. My father retired from this company. So I have a love for real estate. What I specifically do is I'm a real estate advisor, so this is what you can expect from a call with myself or a colleague of mine with this title. We go through why you want to invest, how you can get there, when is going to be the best time, setting criteria, identifying the markets that's going to make the most sense for what you want, and then I introduce you to all the key players to help you get there. So these are the criteria of the 16 different submarkets that we're in that make the reasons why we pick these areas so specifically for the benefits of long-term investing. The job market to be strong, vacancy rates to be low, meaning turnover time, economic diversity, housing affordability. Is it landlord friendly? So different states favor different renter, tenant versus landlord. So we always want to be in landlord friendly states, areas that have strong education, universities, and most importantly, reliable property management to take care of your long-term investments. These are the markets that we're in. As you can see, we're spread out across the country. We're in other markets. I do have resources, but these are the ones that we're most heavily in today. As you'll notice, we have the boxes outlining specific markets, and you might be wondering what that means. We actually have brick and mortar Marshall Reddick brokerages in these markets. So here in Orange County in Los Angeles, we have an office and agents, my coworkers in Clarksville, Tennessee, right here on the border of Kentucky and Tennessee. We're in Austin, Texas, and we're in San Antonio as well. This half line means we're coming soon. So really exciting things and lots of growth in the markets that have done very, very well over time. I have Taylor here on the line, and I'm going to have him take care of this first poll for us. It's very interactive. I want you guys to always feel free to type and go over any questions that you have throughout. We'll be able to answer them as we go. So the first poll, a quick poll to have some fun as to why you're here. Do you think that this is a good time to take advantage of the market change? Please select yes or no, and then we'll share them with the entire audience. Please take a moment to decide what you think. All right, well, I might have to agree with the majority of the audience here. Financing in today's market. I think the next slide we're going to be introducing the man of the hour, Reed Hazard. Yes, Reed, are you there?
Yeah, I'm here. Great to be here. Yeah, and awesome to be here. Thank you all for joining tonight. Sure has been a great last 14 years that I've been a part of Marshall Reddick. It's actually my 15th year with them. I spent most of my career here and started actually working with Marshall as an intern in 2004, and then quickly became a lender in Marshall Reddick. And I've really been a lender here now for just going on 15 years. So happy to be here. These are some turbulent times, and through times like this is really when the best opportunities are really there. But we have to understand what we're looking at and have a better understanding of it and have more knowledge to make the right decisions. So tonight we're going to really kind of dive into the subjects that Tanya went over to try and demystify what's going on so that we can all make the best, accurate, educated decisions possible. A little bit about myself. I've been doing this now. It's my 15th year. I was ranked in 2018 as number 64 in the whole nation out of 600,000 loan officers. So definitely take my job serious. This is my career. I'm also an active investor. I have multiple investment properties out in Texas and out here in California. And I love what I do. I'm very, very passionate about what I do. I've worked with over 1,000 Marshall Reddick clients. And my company, CMG Mortgage, is a large bank. We're licensed in all 50 states. We actually have brick and mortar offices in all 50 states, including Hawaii. My branch is licensed in Hawaii, Colorado, and then I'm personally licensed in California, Oregon, Nevada, Arizona, Texas, Indiana, Tennessee, Kentucky, and Florida. But again, we can help out with loans in any state, so keep that in mind. And down there on the left is my wife, Chelsea, and my son, Pierce. He's a little bit over a year old, so having a lot of fun with him at home. Not really getting too much sleep right now, but definitely just love my family. It's why I work hard. Just love them so much. And then my little girl, Liv, she's 4. So we're going to get on into the presentation here. So the topics that we're going to be covering is, in order to understand what's going on right now, I first want to understand. I want to go over what's happened with the market since the last recession. So we've had so much growth in employment. What's happening right now is just really a black swan. And I really want to kind of dive into that, and I want to explain what that means and just kind of show everybody that we're definitely in a different environment right now than we were the last time that we ran into a recession. So I'm going to go over employment history, 2010 through present. Really the economy last time when jobs got really bad and when, the markets essentially blew up. Really, that was around 2008, but it took a few years before we hit our bottom. And again, I want to go over the employment history from really when it was at the worst point to present. I'm also going to talk about Fannie Mae loan limits and how they're very closely correlated with employment. Fannie Mae is the largest purchaser of mortgage debt. So when you go and you get a loan at Bank of America or Wells or with CMG, we're funding that loan on the front end, and then CMG is actually a loan servicer also, just like Wells or Bank of America, where you make your payments to us. But we're selling that loan on the back end market. We're underwriting and approving it with the intent of selling the actual loan on the back end market, and then we will retain servicing rights. So you'll make your payment to us. But Fannie Mae is really who's been funding these loans with these very low rates since around 2010, and I'm gonna show how those loan limits have been increasing over time due to employment. I'm then gonna go into the effect on coronavirus has had on interest rates and really why the Fed dropped their fund rate to 0. It has more to do than just the coronavirus. It has a lot to do with oil and some stuff that's going on there. So I'm going to talk about that. And then obviously the measures that the Fed is taking to keep rates low. And then I'm going to go into the safest markets for investors, and we're just going to take a look at kind of how those markets performed the last time that we had, a 30% sell-off in the stock market within a month period, which was around 2008. So we're going to go over that as well, so we can kind of look at proof, because the past has a lot to do with the future. Obviously, there's a lot of innovation and changes in technology nowadays versus 10 years ago. But looking at the past is really going to give us the best information and knowledge that we need to make an educated decision in this market. So first, this is the unemployment rate from 2010 to 2020. It was pulled off of the Bureau of Labor Statistics. So 2010, we got to our highest level. Around April, we hit 9.9%. That was probably 13, 14, 15%. But I mean, again, what was actually posted with the Bureau of Labor Statistics, it got as high as a 10% unemployment rate. And you can see that over time here, we just kind of continued to get a little bit better as, companies started to get, higher again, and the economy started to get in a better position. Around 2014 and 15 is really when, unemployment was getting into a little bit of a healthier range of around 5.5% and below. And then you saw, our first Fed hike to the federal fund rate. Right now, that rate is 0. So it's a 0 interest rate that banks are able to lend money at from the Fed. And we had that same thing happen around 2008. And again, around 2016 is when you saw your first increase to the federal funds rate, because we started to see some marginal growth and wage inflation. Still very low. The Fed was targeting a 2% growth, and we were at about 1.5. But we were starting to see some serious signs of growth in the economy. So that's when they actually started to raise interest rates. And they did so all the way through 2019. We actually hiked interest rates 4 times in 2018. It was at every single major Fed meeting, right? The Fed meets every single month, but they generally only hike every quarter. And they hiked 4 times in 2018. Probably did an overhike, if you ask me. And I'm going to kind of talk about that on one of the next slides. But you can see that as employment continued to get better and better, the Fannie Mae loan limits started to increase. So the next slide we're going to look at is the Fannie Mae loan limits. And this is the loan amount that Fannie Mae will lend to nationwide. Doesn't matter of the county. They also have high cost loan limit areas like Los Angeles and Orange County. And I'll show the next slide here in a minute, which will give you that information. But if you look at the Fannie Mae loan limits, 2006, Fannie would lend to $417,000, and then when 2008 and 9 came, they actually didn't lower what they would lend at. They just kept it at $417 all the way to 2016. And then right when they started to see that we had some more growth and wage inflation, they were able to hike it in 2017. Then right around that time, the whole year, Donald Trump fought for tax reform, and we were able to get that bill passed. He also had a lot of other stuff he was trying to push. One of the things, though, that I think really, really did spur a lot of growth in the economy, and it was an amazing policy change, was the tax reform. And everybody, believe it or not, has saved some money off tax reform if you go and look at the actual tax bill. So what that did is it caused wage inflation to go really above 3% growth in 2018. We were month over month, we were about 3.6%. We were almost hitting even a 4 handle, which is huge. And so the Fed had to start hiking interest rates dramatically. And I'm going to go over that on one of my next charts. But even as they hiked interest rates, because wages and because employment was so strong, they were still investing a lot of money into this type of debt that they would buy on the back end market, and they would continue to loosen their guidelines for the amount that they would lend because the wage force needs it. And there was a lot of demand for real estate, and real estate nationwide, we've even seen a lot of inventory shortages. And so how do you get a seller to sell? Well, if you can get them a higher price, and if the buyer can afford it, then you're going to get people selling. So part of why these loan amounts went up is also because really there's a huge demand for it in the economy, and wages could afford it. So we actually saw a huge rise after tax reform 2017, 2018. We saw about a 5.4% increase in what they would lend. They then did it again in 2019, another 5% increase, and then again now in 2020. So there's there's something called the JOLTS report. It's the Job Openings and Labor Turnover Survey, and it comes out every month. It's on the Bureau of Labor Statistics website, and it shows the amount of available skilled labor jobs that are in the market. And these are jobs like, a nurse, different types, an engineer, skilled labor jobs that you have to go to school to get, that pay a very good salary. And there's over 6.8 million available as of this month. So still and we're at 3.5% unemployment. So the jobs look great right now still. Obviously, we have this coronavirus that hit us. It's a major black swan. I'm going to get into that in a minute. But up until coronavirus happening, the beginning of the year, the markets were still at all-time highs, and I do believe money started to kind of move into safer assets just because we're at all-time highs, and everybody starts to feel how much higher can this go. So naturally, there's some risk being taken off. Also, money that was parked in all different types of funds, even including real estate, but in the stock market since around 2010, when you could buy Ford stock at a couple bucks a share, they've made a lot of money up until 2020. So you started to see long money kind of go to the sidelines a little bit more in January. But the economy month over month has still continued to look great, especially for jobs, when even though you have very low unemployment, you have so many available jobs. People like my mom and my dad, they're retiring. They're done working. And someone, my age or a little younger needs to come in and take over. And so for that being said, we've had a great market. It's been a great run. It's been phenomenal, really, up until we had this black swan hit us, coronavirus. So this is kind of just some stuff you can look at that. Remember, the government is the largest investor in mortgage debt in the entire world, right? They bought $80 billion a month in mortgage-backed securities, cleaning up all the bad loans that were written all the way from 2010 through quantitative easing. They did 3 rounds of it. And then, around 2016, they started to do what's called shadow QE. So they would just reinvest the money that they made off all these funds every month back into the bond. And then they actually started to taper off what they would reinvest around 2017 to 18, all of 18, because we had so much wage inflation growth, and they were starting to kind of want to back out of mortgage-backed securities. And that's when you saw also rates in 2018 hit about 5% again for a primary home. And then now through 2019, they just started buying again. And then now through 2020, as we've had a little bit more risk in the economy because the markets are so elevated, we have an election coming up. We've seen some of that money start to go on the sidelines.
Hey, Reed. Somebody had a question on this slide. What does 1, 2, 3 in family mean? Does that mean number of people per household, or what does that mean?
Oh, absolutely. So that's the amount of units. So the 1 unit Fannie Mae loan limit is capped at $510,400 nationwide. If you're buying a primary residence, you could do that loan with as little as 5% down on a Fannie Mae conventional loan. If you're doing a duplex, you would need 15% down on a single family home. And then 3 and 4 unit would require 25% down. But you can get a Fannie Mae interest rate with a very low amount of reserves needed on a 2, 3, and 4 unit. You need no reserves, meaning reserves is any amount of money that you showing the bank, how much am I going to have in the bank after I close in this transaction? How much savings do I have? And for a 2, 3, and 4 family, you need to have 6 months of reserves. For loan amounts above this that are not within Fannie Mae's lendable limits, a lot of times you need 12 to 24 months of reserves. You need to have higher credit and a lower debt to income ratio to qualify. So these are the bread and butter loans where you can qualify with about 49.99% of your money going out of your pocket every month, including the new mortgage debt. So a high debt to income ratio. You can have decent credit, and you can put a minimum down payment. On a primary residence, like I said, 5% down 1 unit, 15% down 2 unit, and then 3 and 4 always require 25. On an investment property, 15% down on a 1 unit as a minimum, and then 25% down for anything 2 to 4 units. Now, when we go to the next slide, I'm going to show here In some areas, like Orange County, Los Angeles, the Bay Area, you can actually go as high as a $765,000 loan amount. So if you look right here, you'll see 765 loan amount. You could do 5% down on a 765 loan amount now. That was 720, 726 last year. So 5.5% increase. On a 2-unit property, you could do $980,000 max loan amount all the way to a 4-unit, which will require 25% down. On an investment property or in a primary residence, you can get up to $1.472 million in a high cost market. Again, the high cost markets all of us know of are Los Angeles, the Bay Area, Orange County, some areas of New York. Okay, so those are the loan limits, just to kind of give you guys though an idea of what the government is funding. And now when I get into the next slide, what I'm going to go over is I'm going to show you guys how these bonds trade on the back end market. I'm going to show you a screenshot. I'm going to break it down for, basically it's going to show you how rates have been affected since COVID-19, and it's going to show really a bigger picture for you guys to look at. So let's go to the next slide. So interest rates before coronavirus and after. So to give you guys an idea, I actually want to show you an 18-month chart, but I'm going to first tell you how to read this graph. So this is the Fannie Mae. This is the 2.5% coupon. It's the most closely traded mortgage-backed security in relation to the loan that you're applying for today. If you're below a 765 loan amount in a high-cost market or below 510,000 in a standard market throughout the U.S. And a mortgage bond, these are traded in billions of dollars, and each bond might be a pool of mortgages, maybe $5 million bundle of those loans, right, with 20% down and these types of FICO scores. And this type of debt is bought and sold on the back end secondary market. The same way that a large investor can go and buy treasury notes, the 10-year treasury note, you're actually buying government debt, right? And then the government's paying you for our U.S. debt. We're the safest economy in the world. So there's a lot of big banks out there and financial institutions that are buying our debt because they believe that we're the least risk of default. But when you buy a note, you're buying debt, right? You're buying the government's debt. When you buy a bond, you're buying a pool of assets. So these assets trade up and down each day in the back end market. Now, green is investors buying the bond. It causes the bond to appreciate, which drives down the yield and makes rates better. Rates go down that day. You know, it's not the other way around. So as this goes up, it doesn't mean that rates are going up. It means they're actually going down. Red is a day when investors were selling the bond, causing the bond to depreciate, which drives up the yield and it makes rates worse. These lines, I want to explain these. The purple line is the 200-day moving average, the average that this has traded over the past 200 days. The pink line is the 100-day moving average. The 50-day moving average is this dark blue line. The light blue line is the 25-day, and the green line is the 10-day moving average. We look at moving averages so that we can get a good idea of the direction of the market. Number one, okay, this is back several months ago. This is back around the end of January, okay? This is back when coronavirus started to become a big deal. It was getting mentioned all over the news. There were people that were, really the scariest part was that around 10% of people that got it were dying. It started to scare people. And at that point, you saw rates get to the best level of all time. Before this, they were great back in August of last year. We had a little bit of worry that the stock market was at all-time highs and that we were seeing month-over-month inflation for wages and GDP growth to start to kind of slow. And it was starting to look like a 2.5% growth rate was going to be hard to keep up with. We were actually at around 3 the year before. Really, we just wanted to be above 2, so it's still good enough. But we were seeing things slow down. Manufacturing sector was slowing down. And so as a result, interest rates got really elevated. Whenever there's lower growth or it looks like the economy is slowing down, Interest rates love that. Investors go directly into bonds, right? Causing them to appreciate, driving down the yield, making rates better, right? And usually you might even see stocks moving in the same direction. This used to be inverse. Stocks would go down and bonds would go up because investors would move into bonds. But it doesn't work that way a lot nowadays. Now you have big amounts of credit that can be given to these different institutions where just because they're selling stocks one day doesn't mean that they're going to move right into bonds. They might own stocks off of credit. They might not even be selling. So it's a really different world nowadays. When now you actually kind of see it going back to the old way when whenever stocks would go down, bonds would appreciate. I'm going to talk about when I get to numbers 4, 5, and 6. We're going to talk about how they're actually both moving in the same direction now and why that's happening. But up until around that point, around August, you were seeing a lot of money kind of start to go back into bonds. And we hit the best rates we've had in a really long time. I was doing like 3.25 30-year fix with no points, 3 3/8. 3.5 was easy to get again, which I hadn't seen that in years. So August of 19 was a great time to be getting a loan all the way really through the end of the year. But then number 1 came, and coronavirus was the one thing. The markets, all these economists are looking for what's the next thing that we're going to have that's going to give us a setback to cause a bear market or put us into some type of a recession. And coronavirus was exactly that. And the market started to get scared, and so we started to elevate. Rates started to get better. We hit the best levels of all time. Then we hit number 2. Trump came on and he gave, basically just told the markets that coronavirus is definitely a big deal, but it's definitely under control, and there's only 15 people in California that actually have it, and most of them are already better again. And the market didn't really buy it because the market looks at coronavirus as slowed growth. And I think the best opportunities come during these times. I mean, the fact that it's a black swan or an unforeseen situation that's hitting us right now, and we have low rates, has really created such an amazing opportunity. But when the stock market's going down sometimes 3,000 points in a day, oil going down, 30% in a day, it definitely scares people. And it can scare you enough where you don't make any action. And so that's kind of why we want to educate you on this tonight. So again, you can make the right decisions right now in this opportunity world that we're really in. And so again, Trump comes out, doesn't do a very good job of keeping people calm, because immediately we saw it just start to elevate. And really it's because the data started to come in too. We started to see that we're definitely getting slower growth already month over month, just from January and February, right? So then we move up into this elevated range, and then number 3, Fed cuts 50 basis points on their federal fund rate, and it was still at around 1.5% for banks to lend off that money. So still pretty elevated. We were as high as we were 2.75 to 3% back in 2018 when the Fed raised rates 4 times. So we came down a lot, but it was still pretty elevated. So we saw them we saw them cut interest rates, helped mortgage rates to get into this perfect storm, and rates just kept getting better and better and better. Then we get to number 4, and this is not last Monday, but last Sunday, not a couple days ago, but like 10 days ago. I'm at my house and I'm watching Netflix with my wife and just getting some time off and hanging out with her. And I decided when she got to go to the bathroom, and I decided to put on Bloomberg just because I wanted to see what's going on. And oil prices are down 23%. And I'm going, whoa, what just happened? And what happened was Russia, Saudi Arabia, Saudis wanted Russia to bring their oil prices down, and they couldn't come to an agreement. And Saudi Arabia decided to flood the market with oil. And that's added another layer of what's going on right now on top of this coronavirus. And from that point, when you see oil dropping like that, this is all going to be probably short-lived. What they did was probably considered illegal, and there's going to be a lot to go through over the next few months over this. But the point is that lower oil prices generally lead to lower price of goods, generally lead to slower growth. We already had the slower growth in place because of coronavirus and the impacts we were already seeing. And as a result, you saw interest rates at the best levels of all time on number 4. That was a 3% free loan, primary residence, maybe even a 2.875. And it was very short-lived. It was a few minutes, literally. And then from there, the end of that day, we saw money go in a flight for cash, okay? It wasn't anymore about holding bonds or holding treasury debt. It became, we need cash. Some of these junk bonds and trash stocks that investors buy, I mean big investors like BlackRock that they invest in, because it's fun sometimes to bet on some small company that's going through hard times, become a penny stock, but if they have a business plan in place and the economy stays solid, then if they come out of it, it could be a massive return. You know, there's a lot of big hedge funds and banks that place those bets, and a lot of times they do that on credit. And so what happened on number 4 is you get such a big drop in the stock market that these institutions, they get margin called and they have to cover, and cash becomes the biggest thing on the street that's needed. And that's why even when you've got all this stuff going on, Fed that just cut 50, it looks like they're going to cut again soon. You know, it's mortgage-backed securities and treasury notes, and any type of investment that day started to get thrashed, and we started to see money move into cash. So let's step back for a minute. On that day, we saw oil tank 30% in one day, tanked about 20 today. We saw the 10-year yield fall to 0.33. Okay, the 10-year treasury note before this whole thing happened, I've never seen it go below 1.46. So it's a really, really big day. You know, this was caused not just by coronavirus. It was caused because of what's going on with oil. Okay, and many could say that oil was already moving into a bear market because of the fact that oil companies need about $50 a barrel oil on average to be profitable, you know, and it's hard to see that we already have a warmer winter, natural gas, and things like oil, they're still running the world, but there's a lot of other different clean energies now that we use. And you've already started to see a little bit of a bear market coming for oil for a while. Well, when the Saudis did that, it just tanks the market, okay? So now let's move on to number 5. Number 5 is when the Fed comes out and they cut rates to 0. So this whole last week, when we saw the best rate of all time, number 4, the whole week we just saw a flight to cash. Stock market would go down 2,000 points. Well, so would the interest rates would also be worsening. And I'm getting calls like, Reed, why aren't rates better? And there's a few reasons, right? One is banks took too many applications and there's not enough liquidity in the secondary market. Okay, the secondary market that buys mortgage-backed securities is not just the Federal Reserve doing it. It's other investors follow what they do. And there just wasn't enough liquidity in the secondary market because of this flight to cash. Okay. The other reason, though, is because the Fed, I think that they kind of knew that they were going to drop it down to 0, because you saw last Friday, you saw that the market got a little bit better, tried to go down below our 50-day moving average, appreciated above it. And then come actually Sunday, we weren't supposed to get an announcement from the Fed until Thursday, which would be tomorrow. We actually got it this past Sunday. Fed didn't want to waste any time. They're like, we're dropping rates to 0. And why they did that, you guys, is because they want banks to pass on help to the consumer, help small businesses, you know, help us get through this black swan that could be a month, 2, or even 3 months long before we see the virus start to taper off, and they can get a better idea of when this is going to end, so they can get a better idea of when companies will start to do better again and quantify all that, and then the markets can all kind of come back. And so again, when the Fed dropped interest rates to 0, it did help out interest rates short term for even mortgage rates, even though it was really done for the entire economy for so many different types of loans. Banks take a beating when things like this happen. And so to keep rates low for them and keep them making money and giving them stimulus, they're going to pass it on to the consumer. If we don't do that, the same thing's going to happen in the opposite direction. They're going to pass it on to the consumer. So number 5 was when the Fed cut rates to 0. And everyone's like, Reed, is my interest rate 0? And I'm like, no, let me explain this to you. So we didn't even get back to the best rates of all time after the Fed cut to zero, believe it or not. You can see it right there. Then the next day, which was yesterday, I was locking loans all in the morning, and we were able to get above the 102.5 right there, and then we sold off beneath it. And then now today, we're back to cash in full effect. It's a flight to cash again today, mainly just because of uncertainty still over coronavirus. And it's starting to look better. There's some good stimulus coming out, but until we find a point where where the amount of cases is starting to go the opposite direction, or it looks like we have some of a handle on this, where, like I said, they can really quantify when it's going to get better again, it's very likely that we will continue to see flight to cash. We will continue to see the stock market have really big ups and really big downswings. It's so important too, if you do own stocks, to just try not to look at it. Don't touch it. I'm not your financial advisor, but I can tell you that this is a strong market that we have. This too shall pass. And when it does, you will see those companies, the really good companies, the strong companies, you're going to see them go right back up again. And again, it's the opportunities that you can find in this market, really real estate wise, with rates this low, that I think you've got to be taking a look at right now. This next slide is great. It just gives you a 18-month view. All right, guys. I just wanted to kind of show you from when we were at the highest rates we've had in a decade, which was November of 2018. I've highlighted the day that the Fed came out and Jerome Powell said, I don't know where neutral is on the federal fund rate. They'd already hiked it 3 times straight that year. We had nothing but just stock market hitting all-time highs, and it looked like the emphasis for interest rates was that they were just never going to stop going up. If you're in the lending industry and you were a mortgage lender, you were focusing everything you have on purchase business, I'll tell you that, because people were only refinancing just to pull cash out, maybe to buy more property. And at that point, that's when the Fed came out and said, we don't know where neutral is. And what that means is that they were continuously going to continue hiking interest rates, because them hiking rates to slow down growth really wasn't working. This tax reform just pushed employment growth so high up and wages so high up that they were maybe going to have to continue hiking. And right around then is when it actually spooked investors enough that we saw a big sell-off in the stock market. And because all this money that had been made, man, it ran to the hills. You remember the end of 2018, you look at your 401k or your retirement accounts, you went down within about a month period. You can see it from November to beginning of 19. All that money was going back into bonds and the mortgage-backed securities, making rates really, really good again, or at least better than they'd been. But that was all money leaving your 401ks and your IRAs and your brokerage accounts, leaving stocks going directly into bonds. And then it just kind of started this slow, movement back into bonds from stocks. And we still had great earnings numbers all of 2019. The market was pretty tapped, and it was like everybody kept looking for a reason for things to get worse again. And it really just wasn't there. Just employment growth, strong companies reporting strong quarterly earnings. So, the biggest companies looking good, but even the smaller mid-sized cap companies, small caps looked great. I mean, really the whole market as a whole. Small and mid caps didn't get back to the highs that they'd seen in 2017, but anything large cap, anything S&P 500 just did phenomenal, and the market as a whole still did well. But you didn't see mid-sized or small-sized companies get to all-time highs again like you did in the S&P 500, which is the 500 largest companies, and like Microsoft and those different companies like that. They just did great all year. But you could see that there was this movement slowly from stocks back into fixed investments. So as you guys can see, 94 on the left-hand side of this little highlight, that's where the bond was trading. We got as high as almost 104. That's 1,000 basis points of change. That's like 1.5% change in interest rates, 30-year fixed rates, right? Because this trades every single day. So that's an 18-month view to give you guys an idea. Interest rates right now, today, when, they're supposed to be so low because the Fed hiked down to zero, right? No, it's interest rates today they've been getting worse. But part of why they look so bad, if you look at Wells Fargo mortgage rates today, or you go online and you see some of these people that are quoting in the fours now on a primary home, a lot of that, remember, is that banks took too many applications with not enough liquidity, and they just took too many applications, a lot of these places, and they weren't fully staffed to handle the volume. So you've got sometimes 5-month turn times at a lot of these banks to get a refi done. Purchase loans are a mess there. And that's where banks like myself really shine. We did $18 billion in loans last year, CMG, but we don't do investment banking. We don't do checking accounts. We don't do savings accounts. We don't do credit cards. We just do loans for home loans. So banks like myself are performing great right now. We haven't had to hike our rates really outside of the market because we have too many applications. But I will tell you, rates today at my bank are significantly worse because of the sell-off that we had today. But we're holding nicely at that 200-day moving average. As you guys can see, this is literally from today. I had these done today to make sure they're as up-to-date as possible. And I believe that we will stay around that 200-day moving average. I believe that the Fed cutting to zero has created a lot of opportunity for banks once we just get some more clarification on the direction of where this is going and we have an idea of how long it's going to go there. When that happens, you're going to see mortgage-backed securities get better, and you're going to see interest rates, because of a zero federal fund rate and the Fed buying what I'm going to mention on the next screen, another $200 billion in this type of agency debt, over the next 3 months. That's quantitative easing. Because of that, we're going to see demand for mortgage-backed securities. So the low rates have not gone away. But short term, I've explained to you why they're not as low for the consumer as they should be at these really elevated levels we still have in the bond market. Okay, so again, let's talk about the Fed Reserve cuts to zero and the main reasons why. Main reason was so banks can provide funding to small businesses and other affected from the virus, and to further keep the economy from falling into a deep recession. And the Fed agreed to purchase $200 billion of MBS, that's mortgage-backed securities, Fannie Mae, Freddie Mac bonds. They also agreed to purchase $500 billion of their own debt to create liquidity in that market. And again, this is going to take effect over time. So these really massive movements that we're seeing right now, they've set the stage for at least low rates for some time. The market's just got to kind of come back to reality and recycle itself. And that's really what's happening right now. And again, I'll read it again. They did this to create liquidity on the secondary market. The idea is the Fed buying will allow others to follow suit, and demand will continue with rates at or near current levels. If we start to get some defaults in housing and mortgage-backed securities, start to have some non-performing notes, there's safe havens already put in place. Fannie Mae is insuring those loans when they have us underwrite off of that type of guideline. And on the back end market, they've already putting now into effect $200 billion of agency MBS they're going to be buying over the next, probably 3 to 6 months. So there's already stuff being put in place ahead of time to safeguard things that could happen in the near future. And that's why they came out with just such an over-the-top, immediate, like, we're dropping to zero and we're going to provide this amount of money immediately. So I thought it was a great move. Okay, so I'm sure that's a lot of information for everyone. I wanted to show this. I'm a real estate investor myself. I own a property in Helotes. That's an area of San Antonio. Christina Dorian, who's a realtor from Marshall Reddick, helped me buy that property. She actually lives in the same community, drives by it every day, makes me feel comfortable. But I love that market, and I wanted just to kind of go over a couple of the markets that I want to just put into perspective. The last time that we had a recession, what happened in those markets? I would say that because of the world we're in today, employment being so strong, JOLTS report showing there's still so many jobs that are needed out there, that even if we run into a short-term problem with employment, that the fact people are sitting on so much equity versus the way that they were sitting on equity in 2008 and 9, and the fact that employment is still so much stronger, even if we have potentially a 3-month almost shutdown in the economy, how we're probably not going to react longer term over maybe a 2 or 3 year period the way that we did in areas that got hit really hard by the last recession that we were in. And one of those areas is Clarksville, Tennessee. Look at what happened in 2009 in that market. 2008, it was 0% appreciation. 2009, 0.8% it went up. drop by 0.53% the next year. These are areas with very diverse jobs, right? These are areas with tons of tenants that can rent your property. These are areas that we would consider to be very safe markets, because even in a market where it was absolute catastrophe for housing, right? Catastrophe for housing. People were buying in 2004, 5, and 6 with no documentation. They would fog a mirror and they would say, I want 10 investment properties, and I work at, at a grocery store, and I'm not an upper level manager, and I make, $150,000 a year bagging groceries, and you could get a loan approved that way. And they do with no money down. That's why real estate took a huge hit when the jobs weren't there and the income wasn't there to support the monthly payments. And when these loans, they were really bad loans that were written. They were 1% NAGAM option loans where your rate might be 5%, but you're only paying 1% interest only a month, and the other money that you're supposed to be paying is being deferred onto what you owe. And so what you owe every month goes up, right? And you can't afford the payments anyways when they become fully indexed and you're making the full monthly payment. That's why we saw such a huge hit to real estate before. And even in that market, you had, like I said, this market performed very, very well. It doesn't have a lot of appreciation over time. I mean, you look at it, rarely do you have a year that's really above 3 or 4%. But it's a safe market, and there's a lot of tenants to rent your properties. I also want to look at, let's take a peek at the Austin market. I found this phenomenal. I also own a home in Austin. I own a property in Bee Cave, which is an area just outside Austin. It's about 17 miles from downtown. A little tech corridor right there. Really, really high rent to price ratios. I bought that property for $570,000. It rents for $32.95. I had it rented within 2 weeks on a 1.5-year lease. People that rented my property are going to be having a home built in the next year or so, and great tenants, great tenant quality. But I mean, Austin is really a market that's just phenomenal to me. I mean, so much growth, so many businesses going there to grow, 0 state income tax in Texas. And if you look at how it performed in 2009, again, went down by 0.64%. 2010 went up again by 3.31, 11 down by 0.26%. What I like about this market is you have very rare times it's ever gone up above 10% in a year. That's a great sign that it's a stable market and that it truly is growing because of population and income growth and business growth. And I love that. Let's take a peek at San Antonio. I own a house in San Antonio, Helotes. It's an area just outside of downtown San Antonio. 2009 went down 2.29%. 2010, 1.14%, 11.99. As you guys can see, another really safe market. There's never been a recorded year above 10% growth in San Antonio since 1995. We've seen nothing like that. So it's another market that I feel is very safe. And that when you can get low interest rates, especially, and a great amount of tenants. There's a big pool of tenants in that market. Days on market, the average amount of time that your property will stay on the market before it's rented is under 30 days there. Even in winter, so I closed on my property in Helotes last year in October, and I had within 9 days, I had a year lease, okay? And I had to give her a new fridge, and I was happy to do that with an ice maker, And she'll probably stay for a long time because I'm taking dang good care of her because they make their payments on time. Marcia does a great job managing it. And it's a safe market. I feel very, very comfortable and confident in San Antonio. I want to pick on one market right now because, you have to look at reality. Las Vegas, let's take a look at what happened in 2008, 9, and 10, 11. This is very much a boom and bust market. I do feel areas like California, because this is a black swan event, I feel like most areas that did have a big up and down still can perform phenomenally. Even if we get a short-term price dip, they're going to go right back up again, and still might even weather the storm pretty well because they're very, very, very diverse economies of employment. There's different types of jobs. There's so many different types of jobs in those markets. Like California is an example, whereas Las Vegas is almost fully based on tourism and on the casinos. And depending on how long the coronavirus goes on, the longer that those companies are not bringing in income and generating income, and if they have to start laying people off over time, it can really, really hurt the real estate market out there. So I'm a little fearful right now of Las Vegas. Anybody on the call that owns there or is looking to buy there, I hate to damper on your parade. I'm out here to really talk about facts right now, and transparency. And I do feel that a market like this could have a pretty tough time, even if it's only short-lived, for a year and a half, year, maybe even 2 years. I feel like when this black swan leaves us, it's not going to be like the last recession where it took so long, literally 2008 till 2014, 15, before people got confidence in real estate again. It's nothing like that. But I do believe that you should see a hit in that market. So I've been able to spend a lot of time with you guys right now. And I wanted just to kind of talk quickly about getting pre-approved. If you go to my website, readhazard.com, we've got a lot of tools on there that I want to mention. There's rent versus own. There's a lot of, we actually recently just had my website updated. It's phenomenal. There are so many tools on there. If you go to readhazard.com and if you look at it, you'll know what I mean. It's a phenomenal website. We are a loan servicer, so you can even set up your actual automatic payments through my website. You can make payments through my website. Go online, check it out. But when you guys are ready to get pre-approved, just let Tanya or the Marshall Reddick team know. They'll put us in contact. You can call me directly anytime. I'm going to have my information on one of the next screens. But we utilize technology at my company. We do a no-cost pre-approval. It's a great time to get yourself pre-approved or even get pre-qualified, which means really just have yourselves run your own credit. Send us a copy of that. We'll get in your documents to verify what you're able to qualify for. And then we can even just watch things patiently and wait to run your credit until we actually get really serious about offering. Anybody that wants to be in a position to buy in the next 120 days and write an aggressive offer, you'll definitely want to get pre-approved now. Interest rates right now, Tanya's going to show some properties here in a few minutes, and we like to default to a 4.125 for an investment property right now. If you do a rate buy down, I have investment clients getting a 3.5% 30-year fixed loan right now on a purchase. I have other clients that are refinancing 4-unit properties, paying some buy down, getting in the mid to higher threes, depending on credit score. Remember that, I'm not a CPA, but I am a real estate investor and I own property. And I can speak from experience that the closing costs that you pay, discount points, any of that you pay, you can write that off against future profit from sale and from cash flow. And so if you can lower your total monthly payments on all your properties combined by $1,000 a month, and it costs you, let's say, even $20,000 to do that, if you recap closing costs in a year and a half and it's tax deductible, and you just improved your cash flow by $1,000 a month, that's where it makes sense right now to go in and refinance a portfolio. If you're looking to get a primary residence loan, again, today's not a good day to lock. I showed you guys the screen, but I believe that we're going to be in this sort of a mid-3, maybe lower, maybe a little higher, but in the 3% range for a long time. Heck, we could even see a high 2% come later on this year after the markets get back to more confidence from where we're at right now. After you get pre-approved, your letter will look like this. We'll send you, really without the property address, obviously, until you're ready to offer, but we'll send you an approval letter for what you qualify for, give you some payment examples, and we'll hop on a call to go over your loan approval. Just some reviews on us. Look us up online. Reviews tell a lot about who you're working with. These are a few of my, this is actually my partner, Al Rodriguez, one of our loan officers, Lisa Nesper, myself up there on top. And again, guys, we can assist in any market in the U.S. Even if I'm not licensed there, I've got a great loan officer that I can refer to you. I really, really appreciate you guys staying on the call and listening. It's been so nice to be able to have the stage tonight and talk about this stuff. I'm very passionate about it. I'm very, very passionate about Marshall Reddick. I feel that the tools we have on the website and the transparency that we've helped to create, along with the phenomenal property management and the markets that we manage in, is truly like, this is your team. This is your go-to. And I mean, I've even told the guys, like, I won't buy a property out of state now if it's not managed by Marshall Reddick. I've had experiences with other management companies, and they have just been nothing like what I experienced with Marshall Reddick. So Excited to have Tanya go into some property examples. This is all my information. I'm right down here in San Clemente, California. And thanks again so much for letting me speak. I'm gonna pass it back on over to Tanya.
All right. Thank you so much, Reed. You are an abundance of knowledge. You've definitely been around for a while and have so
Thank
thank
you.
you so much. So let's see what these lower interest rates can do for you today. Like, what does this mean to you for buying a primary home here in California? What are you paying for rent right now? Would that equal a home purchase here for you? I'm going to show an example of that, and I'm also going to show an example in Texas, here in San Antonio. My coworker Patty, this is her listing, and here's the purchase price: $174,000, down payment at 25%. Closing costs, all you would need to buy this property is just under $50,000. It rents for about $1,500, and the interest rate here, we have it defaulted at this amount just to be safe. So we're always conservative. These are the taxes, insurance, property management fees built in. So this is what you would be getting on a monthly income, $370 basically in your bank account. We recommend that you set aside this money for the future, for future vacancy, future maintenance. A lot of people argue, I don't need 10% for vacancy. However you want to do it, I still want to be your friend. That's why we put these numbers in. Not saying that you're going to use all of it or more than that. These are just the numbers that we're projecting so that you continue to buy with us and refer your family and friends. So this is a wonderful property, well maintained, fully remodeled. I mean, this is just move-in ready for a tenant in a great neighborhood that we would love to manage for you. So here in California, a little bit about what a property at a list price for $750 could do for you with a standard 20% down and closing costs. This is what you would need to purchase this home with no PMI, personal mortgage insurance. We have defaulted to 3.5. So this number can go down, it can go up, just as Reed had shared a moment ago, could be lower. So it all will reflect what your mortgage payment will be. If you are still renting a house with 3 bedrooms, 2 baths, are you paying about this amount? So that's something that you could see. This one already has built-in solar panels, very well remodeled inside. I like it a lot. So that's what your money can do for you today. Now, this exact same property, it works in California for an investment property. So if you're interested here in buying it as an investment, I have you putting down the 25%. This is what you would need to buy it. And here it is a negative, but that's common in California. So here we go. These are your projected profits over a 15-year term of holding. That's principal pay down, market appreciation, etc. But lots of really great things. Just to give you an idea of local and out of state, our website has tons and tons of options for you to review. Now let's take a final poll here. Taylor, I'll let you go ahead and present this for everybody. If you want to take your time, this will help Reed Hazard, myself, better direct you. Let us know which one is the most appealing to you. A, buying a primary residence. B, buying an investment property, or refinancing a property or an investment property, or all of the above. Please select which one you are most interested in here, and we'll get in touch with you. And of course, our phone lines and emails are always open to you. All righty, I think everyone's voted. Let's wrap it out and show the results. Perfect, buying an investment property. All the above. There we go. Reed, we have a handful of questions that people are bringing in that I want you to answer for them. So let me Let me read off a couple of those to you.
Great.
This is a common one that I get often. What bank are you affiliated to?
CMG is a bank, so for all loan amounts to 765,000 nationwide, we are the lender. We're funding the loan, and we are actually the actual loan servicer. So you'll be making your payments to CMG. Banks that are about a quarter of our size or smaller, many times they're funding your loans, even if they're Fannie Mae, Freddie Mac loan limit loans. They're funding and they're selling to, let's say, Chase on a big Chase bank line that they have, or just a number at GMAC. There's all different types of banks out there that smaller lenders fund, even though they're direct lenders and they're the ones funding your loan, they're selling it to another big bank. We are one of the largest wholesale and correspondent lenders out there, in fact. So we are actually the bank. We are funding the mortgages. We are servicing the loans, and we are selling and delivering those loans directly to Fannie Mae, Freddie Mac. If it's FHA, we're delivering to Ginnie every single month. So we are the bank. We are the lender. If the loan amount is above the 765 loan amount, it's a jumbo loan. We sell our loans to Chase on a correspondent level. We get a much better price than you'd be able to get on a retail level. We also sell to Redwood Trust and several different banks. We still in-house fund those loans up to $3 million, so we are the funding lender. But we will sell those loans to other institutions. And then again, below 765, we will service retain those loans, and we are the one funding and selling direct to the GSEs, Fannie, Freddie, FHA, or VA. We're selling those loans direct.
All right, perfect. I'm going to go over this power slide, and then I have Gary that has a couple questions. So here's the power team. This is what Marshall Reddick offers you. Advisors like myself, lender as Reed, can help get you pre-approved. Realtors in each market that we offer to help analyze and guide you to the best neighborhoods there, since they're boots on ground. We have all the people in place to inspect your property before buying, getting you an insurance quote specifically for you, and putting you in the hands of a great property management team to get your home leased out right away. Now, this is a really fun question that Gary asked, and I was kind of holding it for this because it applies to me. I recently talked about this, Reed. He's asking you to predict something that I'm not so sure you can, but maybe you can share a little bit about loans 1 and 2. So here's the question. How soon can a 30-year fixed jumbo mortgage for a primary residence possibly reach 2% for
a 30-year fixed loan? I don't believe it ever will. I think that after I've seen the way that the market reacted with almost a negative interest rate on the 10-year Treasury note, seeing what rates did even when we got that bad, or rather that low on the 10-year, I didn't see interest rates ever jump even into really the high twos. I know some banks were out there pitching 2.75 with a 2-point buy down, but after what I've just seen over this past week, I don't know that it's possible that we'll see a 30-year ever at 2% on a jumbo or on any other type of a mortgage product. But hey, it could definitely happen, you know. And if we do see it, I think it would be over the next 9 months, and you'd have to see just a lot more damage than's already been done by COVID. I mean, it would have to get, we'd have to, you know, we'd have to see the entire country on a lockdown for a really, really long time. And then after that, you'd have to see liquidity come back into the bond market. You're seeing that it's been so negative lately that a lot of this money is not going back into the bond market. It's going into cash. So to answer your question, usually rates get that low, or rather rates get lower because investors want to buy mortgage-backed securities and treasury notes instead of the stocks. Right now, they don't even want to buy gold. They just want cash. So really interesting. I mean, after seeing the 10-year hit, you know, 0.33 and interest rates not even getting to the high twos, I would not wait out for a 2% 30-year. I had a lot of people waiting out for a 2.5% 30-year over the past few weeks, and now they can't even get a 3% 30-year. So I'm very big on take advantage of really great rates while they're here. And if you don't need it, And if it becomes available, then great. And so it is a possibility, but I'd say highly unlikely. That's my answer on that.
All right, perfect. Let's see here. So here's our website. If you guys, haven't gone there yet, we have a lot of tabs. Here's our Learn tab under Education. You'll be able to find this recording tomorrow once we upload it there, but we have an enormous library of topics on all of our markets and market data packs, etc. Here's our Invest tab where you can see our properties in great detail. Here's our website to go check it out. And check out our reviews online. Here I am, this is me, and I'm here to answer any questions that you have. I have a few more questions. Let me see which ones are here. Anna, they do not supply loans for land. Let's see. Oh, here's an interesting question. All right, what about this? I've seen this as well. In other countries, borrowers' interest rates. Let's see. So Gary wrote, in Denmark, negative interest rate for mortgages. Is that a reality? Borrower gets paid to, let's see what he wrote. Borrower gets paid to invest? I think that's a question. Do you have any thoughts?
I think maybe he's referring
at negative rate.
I think he's referring to that in some other countries there's actually negative treasury yield rates, meaning that you have to actually pay an interest rate, or rather you have to pay interest to park your money in a safe asset. And so I think his question is, will we ever see the 10-year treasury note go into actually negative yield where in order to buy U.S. debt to safe haven your money, you actually have to pay a yield, versus where right now I think today it's a little bit over 1% you'd still make on your 10-year treasury notes that you're buying. And the answer is yes. I mean, we could go into negative yields, but with what just happened and what's been happening, and to see kind of the opposite now happening, even as the stock market craters and gets worse, you're seeing the 10-year treasury note go up. That's because investors are selling the notes, moving into cash. So I think we already tested it and we weren't able to get there. It was a short-lived thing that the 10 went down as low as it did. And you got to remember, when you compare these other countries that have negative yields, like Japan, to the U.S., these are much smaller economies than the U.S. economy. So I think you just saw the lowest that you're going to see, at least for the foreseeable future. Again, we have the black swan right now, and the black swan could do a whole number of different things, and you may see it go into negative yield territory. I mean, it would be short-lived, I believe, but you could definitely see it. But it's highly unlikely. Just like it's highly unlikely that you're going to see a 2% 30-year fix actually being handed to the consumer. A bank could do it right now, but are they going to actually? Yeah, it's just very highly unlikely. So
got it. Well, interesting times ahead. This is me with a handful of people that I've helped buy and sell locally. I'm happy to help you next. We've covered a lot of information here. Let me know how I can help you set up your plans, your goals, connect you to the right people for what it is that you want to do specifically, and I'll help get you there. I thank you guys all for your time. A lot of you have asked a lot of personal questions on here that will be forwarded to Reed, and we will be able to get back in touch with you specifically for your questions. I thank you so much for your time, Reed, tonight, and Taylor for helping us co-host this. Let us know what we can do for you. We appreciate you guys.
So happy to be here, guys. Thank you so much. And just give us about a 24-hour turn time on all of your questions. I want to make sure I can get back to everybody timely. And I hope you all have a fantastic night. You all stay safe. And thank you so much for being on our call. Greatly appreciate you.